What's up, traders? What's up, tycoons? Super excited for today's video. We've got another great video. We have to talk about why banks could be in serious trouble, even more trouble than what they previously were in Silicon Valley Bank. All right, and we're going to take a look at financials. They are massive underperformers. We're going to break down a few of the charts showing you guys that. We're also going to talk about some unemployment rates and consumer credit, bonds. All right, lots of bonds talk, right? I know everybody loves TLT, so we're going to talk about that. And there's just so much good data to show. All right, there's some interesting things I need to show you guys about commodities and the US dollar right now, and why that's important. The S&P 500 just put in another lower high, so we're going to see if that downtrend is continuing, or if we can potentially put in a lower high here. Okay, or I'm sorry, a higher low, and potentially try to break out of that downtrend. And seasonality is a big factor. Okay, a lot of people may wonder why I'm bullish on the market and expecting an end of year rally. I'm going to kind of go behind the thesis of that and also give you guys some data to help potentially support that theory. But as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the disclaimer. The videos are just getting better and better, guys. So you're really going to want to subscribe to the channel. I'm doing a better job of getting good, valuable information that other people just aren't putting out there for you guys. Now, if you're not familiar with the channel, I did actually start a completely free newsletter called Investment Intelligence. There's a link in the description to sign up for that. It's completely free to you guys. And if you guys are fans of free, valuable content related to finance and the markets, as well as free trade ideas like this trade idea we put on Tesla, okay, going over some of the conditions that we saw there. That trade turned out very nicely. Not all trades are long ideas. There's even short ideas on SWK. This is Stanley Black & Decker, highlighting rising wedge, looking for where we were expecting price to go. And you can see how that one played out here as well. So if you like free, valuable content and you like free trade ideas being sent straight to your inbox, go ahead and sign up for that newsletter using the link in the description or comment section. I also have a Ko-Fi page. We'll talk about that a little bit more, but there's a link in the description for that. If you ever want to book a one-on-one session with me, I do 30-minute and 1-hour sessions every single week. Now, let's talk about these banks. Paper losses on the most opaque part of U.S. bank bond portfolios are now close to $400 billion. This is an all-time high and 10% above the peak at the start of the year that caused the collapse of Silicon Valley Bank. So think about that for a second. We are actually, the bank portfolios have bigger losses, all right, in terms of paper losses than they did when Silicon Valley Bank collapsed. And we started to see the collapse of many regional banks, right? And the reason for this is because U.S. Treasury yields have continued to go higher, and they actually went higher than the peak that initially caused the Silicon Valley Bank crash. We'll talk more about bonds in a little bit, but financials are massive underperformers. So in green here, we have the S&P 500, we have XLF, the financial sector, in yellow. Okay, and you can see the massive underperformance relative to the S&P 500 since 1999. And then this red line here is the XLF divided by SPY. This is a ratio chart, so you can see the relative performance of the financials to the S&P 500, and that's actually down 50%. So for the past 2 decades, financials have been massive underperformers. Okay, if you take a look, this is 2009 here. So essentially, ever since the lows of the great financial crisis, the stock market has rebounded pretty well. Okay, financials have rebounded, but the performance, all right, relative to the stock market is just absolutely terrible. And this is one reason why I really don't like to invest in financial stocks, stocks in the financial sector, especially, when you speak of investing for long-term mindset and mentality. It did have a good 10-year run up here, all right, from 1999 to right before 2009. Right before, you can see the yellow line was actually outperforming the S&P 500, and the ratio chart here was looking very well, so outperforming relative to the S&P 500. But really, for the past 2 decades, for the past 2 decades almost, this thing has just been a massive underperformer. Now, this is the XLF SPY ratio chart here currently. All right, I've showed this chart before. All right, and it doesn't have to be all doom and gloom. So one could say that we are due for a rally to the upside, but ultimately I think it's just going to be a rally to retest a specific area, right? Last time I showed this chart, we talked about, hey, we had support here, all right, old support becomes new resistance. It became new resistance right here. And we have this bullish divergence here on the RSI where it's making higher lows as prices continuing to go down and consolidate here. So it wouldn't be surprising, especially with a lot of the financial stocks reporting earnings, if we do get a little bit of a pop. But remember, old support becomes new resistance, and ultimately, if we do rally, I think that this will just end up heading back down. Now, it doesn't even have to rally. It is showing signs of trying to put in a bottom here, but it can still definitely head lower. And when we look at some larger time frames, and you look at the Wyckoff method. So this is the Wyckoff method here on the left. This is the weekly time frame for the XLF, and I just want to show you guys how well these two things pretty much line up. Okay, so you have the initial spring where you break above, right? Here's our spring, and then you get this period of distribution in between spring and the breakdown, right? So you have this period of distribution here where you start putting in lower highs. We're starting to put in lower highs here. Then you get your breakdown. Okay, you break down and you throw back above that initial breakdown level, right? So we threw back right over here, and then you get the big correction to the downside. So you see our throwback, big correction to the downside. And now we're in this correction phase where we're consolidating essentially in this correction phase right here. And if it breaks through this correction phase, that's going to put you into redistribution, and that's going to be a massive move to the downside, which is a possibility given the concerns we have around banks and the huge, massive amounts of paper losses that they have. Now, some other things from a technical analysis perspective. The MACD recently had a bearish crossover. Okay, look at what happens after a bearish MACD has the bearish crossover and it's below zero. Right here is when it's below zero, and you can see that that's when we had a massive breakdown afterwards. Literally the breakdown part of the chart. Well, we've got the bearish crossover here, and we're right at zero on the MACD. So if this continues to go down into a downtrend, we've seen what that signal has done in the past. We've also tested the 200-day moving average, this blue line here, many times, right? A few times over here, a few times over here, many times over here, and we bounced off of it again. If we lose the 200 weekly moving average, that's also going to be a bad sign, in my opinion, and especially if we flip that level in that area to a level of resistance. Okay, these blue shaded boxes here, these are also gaps. All right, so there's gaps on this weekly time frame chart. These gaps, they tend to fill about 90% of the time. What's a scenario where these gaps would fill? Well, it is this Wyckoff method. Now, this is not a chart to live or die by. This is one possible scenario. The environment changes every single day, and this does not have to play out, but this is something that I've been monitoring really ever since Silicon Valley Bank. And the more I look into financials and the performance of financial stocks over, the long run, it's really just something that I'm not too interested in investing in. Now, there may be plenty of trading opportunities, and that's fine. Now, the UNS unemployment rate was unchanged at 3.8% in September. And so what we're seeing is we're just seeing it gradually kind of creep up here, right? We hit lows of 3.4%. It's gradually creeping up. But what we really need to be cautious of is these rapid accelerations in the unemployment rate, which is kind of what the Fed has been hinting that they want, right? I mean, everyone's saying we're not going to have a recession until people start to lose their jobs and the labor market continues to be strong. But look at it right here, right? It's basing out. It seems to be bottoming out, and it's slowly ticking up. If we see a rapid acceleration, what we have is the S&P 500 underneath here in our chart, and you can see when we get this period here of rapid acceleration, we have a significant pullback in the market. Right now, this is a monthly time frame chart, so these pullbacks are significant. Right, these are months and months and months of pullback. Right, same thing over here. We have a significant uptick in the unemployment rate, and then we see a significant pullback. All right, over here, significant uptick in unemployment, we have a pullback, significant uptick in unemployment, pullback, and this pretty much just repeats itself over and over again. And it's something that you guys need to be cautious of, and you need to, pay attention to and be aware of. And this is something that you want to monitor, right? Is going to be a rapid increase in the unemployment rate is going to be bad news for the stock market, right? And most likely lead us into a recession. Now, moving on, total consumer credit unexpectedly dropped by $15.6 billion in August. The consensus called for $11.7 billion increase. So revolving credit rose by 13.9% year over year, while non-revolving credit declined by 8.9%. So this chart is your U.S. consumer credit change, and you can see where we're at right here. And this was for the month of August. And not a good look, guys. Unexpectedly dropped by 15.6 billion when it called for an 11.7 billion increase. Okay. And what does this mean? Well, banks are not lending out. Okay. And the credit is getting less, right? There's becoming less credit. All right. Now, shout out to my credit cards. Okay, they actually just gave me another credit limit increase yesterday. Didn't even ask for one. So some they are still increasing credit and giving out credit, but overall, I mean, you look at the trends. This is a huge surprise, guys. And what's a reason for this? Well, it could be these massive amounts of paper losses, right? That the banks are sitting on their portfolios. Now, U.S. bonds attracted $2.3 billion in inflows. And this is weekly. Okay, so your total weekly U.S. fixed income inflows. And you can see here at the end of September, all right, we saw a significant uptick. Really, there was only one since 2023 has started. There's only been one negative inflows when it comes to the bond market and U.S. fixed income. And there's lots of people putting money into the bond market right now, and it makes a lot of sense. For the first time in a very long time, we're actually having good treasury yields, right? And we're actually seeing attractive yields in the treasury market. Now, that doesn't mean that it's going to be an instant play or instant success, but especially when you look at short-term treasury yields, they they're the whole reason we have an inverted yield curve is because the short-term treasury yields are paying more than the long-term treasury yields. So, bonds have been very attractive throughout the year. This doesn't mean that investing in bond ETFs has given you good returns, but rather, investing in shorter term treasuries for the yield has been very attractive to a lot of people right now. Now, private clients buying bonds the past 4 weeks versus small equity outflows. That is what we're looking at in this chart. And you can see that they're actually buying bank loans, growth, value, and then they're selling tips, which are treasury inflated protected securities. Okay, they're basically like inflation bonds that adjust with inflation. They're selling financials and they're selling low volatility ETFs. Now, all right, it makes a lot of sense to me why people are selling financials. I kind of gave you guys that whole theory there. Selling a lot of low volatility stocks is very interesting. This kind of suggests that they're putting more money into growth, which we can see that that's actually true here. All right. And growth is going to be, more volatile, higher risk, higher return, and then tips is actually really surprising right now because, the tips is actually very attractive right now because let's say you think that inflation is going to come back with a roaring vengeance, then you would want to get into something like tips right here. And it still is offering an attractive yield at the moment. And if we do happen to get a massive resurgence in inflation, this is the kind of the time when you would want to be investing in tips in a sense, and looking for those treasury inflation protected securities. Now, if we move forward, bonds were oversold. Previously, these oversold sell-offs all foreshadowed or coincided with events, right? Now, not all positive, not all negative, but let's take a look at some of those events, right? We have October 87. We have the crash in October 87. In May of 1994, we got the tequila crisis. In June of 1999, we got the dot-com bubble. In March of 2021, we got the crypto pop. In October of 2022, we got the NASDAQ pop, right? So, this is kind of when the stock market bottomed, right? And we can see the dot-com bubble. So some of them were positive, some of them were negative. But we recently hit that again here in October of 2023. And then, maybe the event this time, one could say, is the, Israel, Hamas, Palestine situation. I'm not really sure what they'll call it in the future, but I'm sure they'll end up leaking some type of event. If my theory about the banks is right, we could start to see some really bad things happening in the banks. We could potentially see more bank runs. It just depends how these, banks are going to handle these paper losses. that they're sitting on, very massive positions. Now, consumer funds saw the largest 2-week outflows since February of 2014. These are consumer fund flows. So think of, things like XLY, okay, consumer discretionary stocks. Sorry about that. Your consumer discretionary stock ETF. Now, historically, the USD and commodities are the only places to hide when bond yields and credit spreads are rising. Okay, so if you look at the asset performances in a rising bond yield and rising credit spreads environment, the USD is the only hiding place, right? So this is the US dollar, this is commodities, you have global equities, your global 60/40 portfolio, and then you have gold right here as well. And this is something that a lot of people haven't understood, and that is driving the US dollar higher, the Dixie higher. Okay, if you take a look here, this is DBC divided by SPX. This is another ratio chart. So we're looking at is basically your commodity ETF versus the S&P 500. So if this is going up, this means that the commodity ETF is breaking, or not breaking out, but is outperforming the S&P 500. Now, this is 2020 right here. Okay, this is the very beginning of 2020, and since 2020, the commodities have been in a bull market essentially and outperforming the S&P 500. We have gotten a pullback, but one could say that this was a bull flag. Okay, one could say, many things right here. One could say that this was a falling wedge, right? If I was to simply just draw another trend line right there, you could see that that was a falling wedge. We're just going to try to keep things simple in today's video and, just highlight how they have broken out. Now, there's a key area that we're in right now, okay? Old support pushes higher, old support pushes higher, becomes new resistance, pushes lower, becomes new resistance, pushes lower, and now we're testing that zone again. Are we going to see a breakout to the upside? Are we going to see a breakdown to the downside? Well, this chart, okay, when we talk about a rising bond yield and rising credit spread environment, suggests that commodities could continue to push higher and potentially outperform the S&P 500. This is the US dollar index, your Dixie right here. Very simple concept here as well, right? Old resistance, old resistance. You see we're breaking through. We came back and retested it, and it's now acting as support, pushing us higher. And, I've been talking about the dollar really since we've been over in this time period here, looking to, where it was going to come up to. We wanted to see, was it going to push higher up here or was it going to come down? And we've actually broken out, retested, and we're still trying to push higher here. And one reason for this, that you're seeing strength in the US dollar, is because of this environment that we're in and basically the environment that I'm describing. Now, within equities, okay, and within equity sectors, there would literally be no hiding place to allocate where EPS growth could surprise positively, okay? And so you take a look at the correlation with US 10 yields and the correlation with US high yield spreads. The top right corner right here is where you would be looking for your quote unquote hiding place, right? Somewhere where EPS growth could surprise positively. And we see that all of the sectors are not in that top right quadrant. We can see that the S&P 500 has been clearly in a downtrend as of late, right? I mean, it's very easy to spot, right? We have a high, we have a lower high, we have a lower, another lower high, we have, a low, and we have a lower low. So, we're basically continuing this downtrend here at the moment. Most notably to me, we rejected our anchored VWAP from our higher low, or lower high over here. We rejected that 4 times on the daily time frame here, and pushed through our weekly anchored VWAP, pushed through that 38.2% level here, and now we're approaching the monthly VWAP here for October. So it'll be interesting to see if buyers can step in right around that 4,300 level, potentially to push things higher. There will be some buyers present around the anchored VWAP, but ultimately, if we lose that anchored VWAP, we're heading back down to 42.68. All right, and we've got some support here right around 42.20, 42.25. That's kind of where we found some support and started this initial rally. But if we break through there, we've basically got 41.95 and 4100 are going to be the targets to the downside. These blue boxes, these are what's known as gaps. Okay, these gaps, they tend to fill about 90% of the time. The big questions are when. So you can see we've got 2 notable gaps to the downside that would cause a lot of pain in the market if they were to fill. We've got a gap up to fill that we're very close to filling, and then we've got another another gap up here that we're pretty close to filling as well, or, pretty far away from filling. So for the time being, I would just look for a potential gap fill up here to about 4,400 if we can get some bulls to step into the market. If not, then we're going to monitor and see if this downtrend continues. Now, if we're able to come in here and put in a higher low, right? So we talked about, lower highs and lower lows. If we can actually come in here and start to put in a higher low and then come in here and put in a higher high, that could be a sign of us potentially breaking out of this trend that we've been in right now. Now, I did mention that, the chart doesn't look great here. We're in a clear downtrend. There's no hiding it, no doubt about it, but I am bullish on the stock market and the S&P 500. And I do think we're going to have a strong end of year rally. One reason being is going to be your pre-election seasonality. You can take a look at the average year in purple, and you can see how the performance of the average year is. And in your average year performance, you tend to get a bottom sometime around the bottom of October, and then you see a strong push in through November and December. The stock market also typically tends to perform well around holidays. So let's do a little bit of common sense here. What's around the end of October? Halloween. That's a holiday. What's in November? Well, you've got Thanksgiving, and then in December, you have Christmas as well as the other religious holidays in December as well for the people that don't celebrate Christmas, right? So, three major holidays. Then, of course, you've got New Year's right there on January 1st. So the stock market does tend to like, these holidays and tend to perform well around it. The blue line here is your pre-election year, and you can see how much greater their performance is in these pre-election years. And, again, what we're seeing is a bottom typically around the end of October here. And then we see that push up higher, really to suggest a strong end of year rally. So, I'm thinking that a lot of things line up and, are making a lot of sense in the market right now. While we have this downtrend heading into October, we would expect to see some lows here put in October. This is another cycle composite components for 2023. So, the blue again is going to be your pre-election year. Bottoms right around October, at the end of October, right before November. And then the green is going to be every year between 1950 to 2022. All right. So this is basically your last 70, 75 years roughly. And what do we see? Well, we typically get a bottom here right before November. All right. And the gray line is going to be every year ending in 3. So 1953, 1963, you get it, right? And basically what we're seeing here is we're seeing a bottom in November here. Okay, so that's the difference. So if we were to just simply take a look at these, so 2 out of 3 suggest a bottom in October, right? You have your every year from 1950 to 2022, and then you have your every pre-election year, and you have one that suggests we bottom in November. Okay, and that's going to be your every year ending in 3. All right. So, when you take a look at a lot of this data, again, it suggests that we do get that end of year rally, that strong end of year rally. The big question is, do we put in a bottom in October, as these two suggest, or does it take until November, right? What's also really interesting is that you typically see another pullback in November regardless. Okay. It's just a matter of, is it a higher low like it is here and here, higher lows, or is it a lower low as it is in here in this instance? Okay, so all 3 are bullish for the end of the year. 2 out of 3 are bullish, suggesting a bottom in October. 3 of 3 suggest we get a pullback in November, and 1 of 3 says that the lows are put in November. So that's basically how you would digest this information that we are looking at right here. And what is some economic data that could help support this? Well, U.S. employers added 336,000 jobs in September, smashing estimates of 170K for the largest gain in 8 months. July and August also saw upward revisions totaling 119K. So this is your non-farm payrolls, your NFP. I'm sure a lot of people remember that initial crash that the market had when the NFP report came out. While the market may crash initially, okay, this is actually good for the economy, right? And we're basically just in that weird time period right now where, good news is bad news is good news. And, we're basically living in the upside down right now. But eventually, good news will be good news again. Bad news will be bad news again. And we're going to eventually get back to those environments. But for this, I mean, this is suggesting a strong economy with a strong labor market. Macro growth in Q3 was also solid, and we see this driving earnings growth into clearly positive territory on a year-over-year basis. And more importantly, in our view, the level of earnings up sequentially for a third straight quarter to a new high, right? And this is from Deutsche Bank. All right. And you're just taking a look at the estimates for global GDP growth. This is something that I've mentioned to people that, GDP forecasts, for the future, they are positive, right? And they do look good. If you look at the last couple GDP reports, they've basically been flat. And we haven't seen really good crazy good GDP. Now, of course, we have lots of factors such as the United Auto Workers, the UAW strike. That's definitely going to be impacting GDP. But a lot of analysts, a lot of these banks, who are underwater, coincidentally, they are projecting good GDP growth into the future. And so we're going to see if that can be reflected into the stock market. Remember, the stock market tends to be forward looking. So if they're projecting growth in the future, we may start to see those gains in the stock market today. Right, or not necessarily today, but in a sooner time period. And so finally, all right, relative to the same quarter a year ago, these are the sectors expected to see improved net profit margins in Q3. It's going to be tech, financials, utility, communication services, industrials, and discretionary. So, earnings season has officially begun again. All right, and basically we're seeing we're expecting to see net improved margins on almost all the sectors. The only ones that we're really not expecting to is going to be in real estate. No really big surprise there. In energy, all right, we'll see how things change. If things are going to change with this whole Israel Hamas situation, and global tensions, we'll see how that affects the prices of oil and energy, and things could change in the future for 2024. Materials also not expected. And then you have healthcare as well and consumer staples. The rest of these, as we mentioned, tech, financials, utilities, communication services, and discretionary, which a lot of these are the most important in my opinion, right? You have tech. Okay, then you have communication services, you have industrials, and then you have discretionary, right? If you can see those four areas leading growth in the market, then you're going to see some nice returns in the stock market, right? And of course, that's my opinion, but it makes a lot of sense behind that there as well. Now, thanks for watching today's video. Don't forget to sign up for that newsletter, okay, guys? It's investment intelligence, link in the description. Get those free trade ideas, get that really good free valuable finance content straight to your inbox every single week. And if you guys want to, all right, you can use that Ko-Fi platform. Both of those have links in the description. You can come on here, you can directly book a session with me for a 30-minute or a 1-hour session simply by clicking on the commissions page. You can also request a specific YouTube video on the topic of your choice. And if you ever enjoy the free valuable content I put out for you guys, you can always click on this buy a coffee button, and it's basically a way to leave a tip or a donation.